Hello, everyone. Chad Frantzen with the Kingdom Finance Show. And on today's podcast, I'm going to be sitting down with friend and business entrepreneur Billy Epperhart, and we're going to be taking an in-depth look at the U.S. and global economy, interest rates, the markets. And we had a really good time recording this, so much so that we're going to split it into two episodes. So this will be part one of my conversation with Billy Epperhart, talking about our view of the markets, our expectations for 2024, and how we are personally investing our resources. I hope you enjoy. Well, hello, everyone. Chad Frantzen. Welcome to the Kingdom Finance Show. And on today's episode, I am really excited to have friend, mentor, business partner, Mr. Billy Epperhart, joining us today. And Billy, thanks for joining us on the Kingdom Finance Show.
Man, Chad, I'm excited to be here with you, and I appreciate all the things that have been happening through the Kingdom Finance Show and all the listeners that are out there. We got some really good information today.
We're great. We were just talking offline about what's been going on in the markets and the economy and things like the Magnificent Seven, which is that a Western movie, or are we talking about stock market? So we got some good content today. I know, we're really excited about 2024 and some of the things going on at Wealth Builders and what we're doing on the investment front. So let's just jump in. The S&P 500 reached 5,000 for the first time ever last week. And what's your take, Billy, on kind of what you're seeing in the markets right now?
Well, we had something happen in the market. We're recording this on a Friday, and just last Friday here in February of 2024, last Friday, we had something happen, Chad, in the stock market that we haven't had happen since the day after Black Monday in 1987. Mm-hmm. And what happened is that we actually had the number of market losers in the S&P 500 was twice the number of market winners. So what that's telling us is a couple of things. One is that really it's the Magnificent Seven. It's Apple and Amazon and Alphabet or Google and Meta, Facebook, and NVIDIA, the big AI technology company. All of those are pulling the market up, right? And but the fundamentals and the healthiness of many of the other stocks in the S&P 500, they're some of them are really hurting. And so what's happening is that those big companies have really pulled it up. But so I think that's one thing that's going on. And what that means is, people say, what does that mean? Well, what that means is that, if we broke 5,000, I think there's a false inflation of value there across the board where those stocks are pulling it up. Then the second thing is I'm convinced because of the implosion that's in China right now. China just in the last 2.5 years has lost. China with Hong Kong, which of course is now China, has lost over $7 trillion in their equities market. $7 trillion. So people go, well, how does that affect me? Well, it affects you in two ways. One is the people that are invested in that market need to find a safe haven for their money. True. And so what's happening is they're putting their money over here, which is then in turn, many of those dollars are driving up our market, and they're putting it in a lot of that is going into those Magnificent Seven. And then the other part that's happening is that the commercial real estate market in China is absolutely just imploded. And so the part of all that is money is looking for a safe haven. And right now, it's finding that in what it considers U.S. equities. Yeah. And of course, we can talk about bonds and stuff here in a little bit, but right now, I think that's really part of what's going on. Now, people that are smart and wise, they can take advantage of the uptick, but I'm going to tell you what going up is definitely comes down. If you look at the Buffett indicator right now, which basically is the value of the S&P 500 compared to where we are with the gross domestic product, right, that Buffett indicator is flashing red right now that the market is definitely overpriced based on fundamentals. And the last thing I'll say is the market right now, here within just a couple of days of when we are talking about this on air here, it was around 32 times what we call price to earnings. And so that means that, and the normal that we've looked at is, 15 times earnings. So we're over twice what the regular price to earnings are. And people always say, well, it's a new season, it's a new time, you got technology, you got this, the AI we were talking about driving it up. But the truth is, I know I know I sound like a broken record probably the last 2 years on this, but it's just a weird time that we're looking at in the market. So and we'll talk about here in a minute, about what to do with it.
Well, and there's been a lot of market manipulation, if you will, by just Federal Reserve and interest rate policy. And, I think a lot of people have FOMO, that fear of missing out. And what we see is a lot of people think in their retirement plan or brokerage accounts that they just put it in the index or the market, let's call it, and they think they have instant diversification, right? But the S&P 500, which is the 500 largest publicly traded U.S. companies, it's really become the S&P 7, right? And last year, I don't have the exact numbers, but those other 493 public companies, a lot of them were flat to negative to low single-digit returns.
That's correct.
And so to your point, a lot of that money is just chasing big tech, high valuations. And just so listeners understand, Billy, when you talk about this price to earnings ratio, it's around 32 right now. Historically, you're going to see it around 15 to 18. That's really just telling how expensive something is,
That's
right?
correct.
Whether you're buying a car or a Rolex watch or a piece of real estate, this is a metric for, well, am I overpaying for it? So a lot of people, why would you say a lot of people are overpaying for it? I think some people are hoping for multiple expansion, that that's just going to continue to grow. But at some point, financial gravity, is going to come set in. And what's your take? You obviously think that's way too high value, and I agree with you. Why do you think a lot of investors are just continuing to flock to those type of rich valuations?
Well, I think one of the first reasons is a lot of investors don't know what else to do right now. And so they're going there, and I'm talking about, the real smart money is not in the headiness of the market. And I think meaning they're not in that frothiness, they're staying out of it. And so I think right now, we talked about some alternatives in places you can go and before we came on. Sure. So there's some opportunities that I think we've talked about. One of those has just been what we've preached some is just good value stocks that are paying dividends. Those are always a good place to go. And then, of course, one of the things we're offering now in Solomon Fund that we have is, the private equity is a complete diversification away from the market itself. And when I say complete, it's really a total different type of financial exposure when you're going into some of these individual companies like what we've done in the private equity arena. So that's a couple areas. And then your short-term fixed investments, your short-term bonds, CDs, that kind of thing. Those right now, they're still paying really good, because the interest rates are up.
Yeah, so we're going to drill down on that a little bit more here at the end of the show. We'll talk specifically on some of the things we like. Billy's already alluded to some of these asset classes that we feel are prudent to be in. Again, we're not giving you advice. We're sharing ideas of what we're doing internally on that. Let's talk, before we go into that, let's talk a little bit about interest rates.
Okay.
We were talking about the bond market earlier. The bond market has always been a really good indicator, maybe even more so than stocks and real estate, of how the economy is doing and what the future expectations are. The bond market has predicted every recession, going back to World War II.
Never missed.
You were educating me before we came on just on some of what the bond market's been saying, and even this past week with Fed Chairman Powell and the Fed meeting, what he said compared to what the bond market had been assuming was going to happen.
So I think what's happened is that the stock market and the bond market had priced in what we call basis points, 150 basis points over the next three, starting in March. They saw 50 basis points is basically 0.5%. So they were basically pricing in that in March and May June or July, they were actually going to lower, at least by September, they were going to lower the Fed lending rate by 150 basis points, which is basically 1.5%. Well, what's happened is that first of all, the Fed is not going to lower in March. They've already said that. And secondly, it's going to be 75 basis points, right? Excuse me,
25.
Yeah, total of 75, 25 basis points that they'll do in each one. And I don't think, Chad, they're going to do it until September. I think they'll do it in September to try to help influence the election, is my opinion. But I think that right now that inflation in the economy is kind of like a stubborn grass stain in your light colored blue jeans. You wipe, you put Clorox in it and you get it out, and you
But
can
it won't go away.
Won't go away. You still see that green in there. And I think what's happening right now with inflation is that I use some luxury indexes like we were talking about before we came on.
Yes.
I look at the Bloomberg watch index for luxury watches like Rolex watches, and you can see where they got so overpriced. Some of those watches on the used market were selling for double or triple what the normal retail price is for a new watch. I mean, it was crazy. And what I'm watching is I use that as an indicator of the frothiness, where it's just, we're in a bubble kind of thing. And so I've seen some of that start coming down. And so we're starting to see other types of luxury items, that are either not selling or they're coming down on the used market. So I think the point of that is that there is some taming of the bubble and some taming of the frothiness. But I think inflation at its core right now in the U.S. is a little more stubborn than people think it is.
Yeah, and we talked here on the show about what we call double dip inflation. The inflation's come down significantly, but to your point, with the job market's still hot, and prices, particularly food. I mean, you go to restaurants, and I talked to a restaurant owner this past week when I was in there in Colorado Springs, and it's like the amount of milk and eggs and things that they need for their staple items of. You're talking 30-40% increases. And so I agree with you. I think just that stubbornness of inflation and with the job market, that's going to be the balancing act of kind of a muddle through economy. Going back to, you mentioned the crash of 1987 and Black Monday, that was about a 27% drop in the Dow Jones. I had to look that up. I didn't remember it. I was still in grade school then, Billy. So, but
I wasn't.
But I knew it was significant. But so that, just to give people perspective, one of the terms we use in the industry is the trend is your friend until it's not.
Until it's not.
And the other thing is risk happens a little at a time and then all at once. And what I mean by that is everything's going well, and then over a weekend, it could be some political thing, geopolitical thing, whatever, and then all of a sudden the trend is not your friend, and it can happen very quickly, like within a week.
No, it can. And all you need, sometimes we talk about the black swan events that happen. Of course, that will trigger it in just a couple of days. But I think, also there's some fundamental things going on right now that people don't know. I think right now there's mega exposure in the U.S. in commercial real estate, and the balance sheets of many banks. Still, we had the failure of the California Bank and a couple other banks that happened 6 to 8 months ago. But what's happening now, I guess one of them almost a year ago now, but as you look back on it, there's still that exposure, especially to office space kind of commercial real estate and some others. And so because of that, I think we still, that has not washed through yet. It does not. That still can have an impact on us. And so, not just to sound negative, because we'll talk about things you can do, but the truth of the matter is you just have to be aware of what kind of current environment we're in.
To kind of go deeper on your point on some of those luxury indexes like the Rolex index, the big money, the ultra high net worth families and groups. They're not worried about interest rates to go buy things,
Right.
but I think there's a lot of insight. If sales in luxury yachts or Rolexes, some of those higher end things are going down, to me, that's saying, hey, some of the big money is saying, hey,
Smart money.
there's some headwind here. We're not worried about having to get financing to buy anything, but
Right.
we're not gonna.
No, we're going to keep our powder dry. We're going to hold on to our money.
Mhm, mhm. So I think that's really telling that the average investor doesn't really catch that. You're not going to see that on CNBC or in even the Wall Street Journal for that matter. Let's talk about the Fed. They have a meeting in March 20th, that they meet in May, June, July, and then also September, as well as a couple other dates. But the election is pretty big. We got a big election this year, presidential election year, a lot of seats up in Congress as well. That's November 5th. And the Federal Reserve, I want to go back to your point, they meet September 18th.
Yep.
Is the last meeting before the election. And then they actually meet 2 days after the election on November 7th. So what do you expect as we head into the fall? We know there's going to be all kinds of chaos and uncertainty around the election. And what do you think the markets are going to be expecting going into the fall?
Well, I think what we're going to see, the Fed meets March, and then I think the next meeting is in June.
They meet May 1st, middle of
next
June.
meeting May, then June, July, then September. And I think what's going to happen is that as we stated, that inflation is more stubborn, and I don't think that they're going to actually lower rates. And honestly, I think that's still a little bit up in the air whether they'll lower or not. I think I was reading about the Fed governors here this week, and this would be of a lot of interest to our listening audience. Is that reading about the Fed governors, and I was blown away. I started to put that in my notes. I was kind of on the run when I was reading it, but you realize that of the Fed governors, now these aren't just the top Fed officials we have on the central bank, but then those that are around it, that on the central bank itself, right, the actual Fed chairmen that sit on there and the ones around it, 90% of all of those that are in the central bank right now are declared Democrats.
Is that right?
That's exactly right.
I did not know that.
No, over 90%. And so what that, I could understand 60-40,
Yeah,
over 90%. Well, right now they're, I'm not just sitting here arbitrarily criticizing the Fed. What I'm saying is sometimes, I'll tell you why I'm saying that is because they've gotten over into stuff where they want to influence economics, like on climate change. And very candidly, there's some other things that we definitely don't agree with, from a woke, anti-woke, or a value system that we have that's based on the Bible, right? And on the written word of God. And you see how some of those guys think. And so you say, what's the point of that? The point of that is I think they will try to influence the election a little bit, maybe not what they would call directly, but indirectly. And that's why I think they're going to do their best to try to give us a rate cut. But I think that inflation is a little more stubborn than that. And truthfully, you probably could go into next year, the beginning, early stages of next year before that first rate cut. But something's going to happen before the election.
So you're telling me that the Fed governors are big proponents of Bidenomics?
Exactly.
Okay.
That's what I'm saying. I just make sure I say
Bidenomics, right? So apparently it's working really well. So, you talk to small business owners, not so much, but
our people going to the grocery store,
consumers. Yeah. No, I think that's true. I think rates. I wouldn't be surprised if they cut in July, just if they're really going to try to influence in that regard.
Yeah.
I think September for sure. I think one of my main takeaways is, the bond market has said to come back to reality of, well, this is not going to be as quick a cut. You talk to a lot of realtor friends, mortgage companies. a lot of them are very optimistic that in telling, buyers, and I get it. Hey, rates are probably going to start dropping in March. I mean, I think I hear that from every real estate professional and mortgage person, and they may, but
I think it's too early.
yeah.
Yeah, just so we're clear.
So our position is it's going to be delayed on that.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.